Jane Kelly is refinancing her home loan for the first time in 10 years after the interest rate crept up to just over 7%. She found lower rates online and tried to negotiate a better deal with her current bank.
I know we're a good customer and maybe the bank would want to keep us and would be interested in giving us a more competitive rate.
But the bank wouldn't budge.
We've gone through a broker and I found another rate with another bank that's 1.2% lower.
Often the best deals are available to older Australians with more equity in their homes, who are considered a safer bet. Refinancing hit a peak in July. While it fell slightly in August, more than $20 billion worth of home loans were still remortgaged. According to the banking regulator, the Commonwealth Bank has lost market share for 2 months in a row, costing them billions, to the benefit of the other big three banks and Macquarie.
This is not normal to see their home loan book go backwards rather than forwards. The last time this happened was over 5 years ago, and for it to go backwards in 2 consecutive months is significant.
The mortgage wars broke out earlier this year, with most lenders offering cashback incentives. CBA was the first to wind back its offer in an attempt to cool the market.
I certainly think it's been a strategy where CBA haven't been as sharp with their pricing, so they haven't been reducing the interest rates as much as what some other lenders have been in terms of discounts.
Analysts and mortgage brokers now believe the bank won't allow market share to shrink much further, suggesting the competition could heat up again soon.
If Australians continue to refinance in droves, they continue to switch away from Australia's biggest bank, they will be forced back to that negotiating table.
I'd also be expecting that there will be some lowering, I'm hoping, of CBA's interest rates to compete with some of the other lenders, because we certainly want competition between the banks.
The experts say it's worth keeping an eye on interest rates over the next few months. But when doing your comparisons, don't get caught out by low introductory offers that after a year or two roll on to a higher rate. Instead, look at the life of the loan and do your sums. That's what Daniel and Shayla Baisley did. They refinance every few years.
I was looking for a better deal. I mean, everyone's always looking for a better deal, but particularly for myself, I was trying to get a green loan as well, so I could get some extra solar panels and a battery and replace my gas hot water heater. That was really important to me, and trying to reduce those bills at the same time.
They did the comparison themselves and found a lender with the extras and a rate 40 basis points lower.
There's definitely some good deals around there, and I guess be thinking about what is your priorities and what other things you can get in a home loan aside from an interest rate.
Being smart when playing the home loan game.
Chasing market share comes at a cost for the Big Four and smaller competition, with evidence some lenders are writing loans below the cost of capital. It's making for an interesting reporting season as 3 of the Big Four prepare to deliver their 2023 financial year results. UBS analyst John Story joined me. Welcome. Housing credit is growing, yet CBA's home loan book has shrunk 2 months in a row. CBA has long been a favourite of investors. Could that be about to change?
We don't think so. I think the shrinking of the home loan book, I think, is a very deliberate strategy for CBA. They've called out that the economics around mortgages and the pricing around mortgages became a little bit too irrational for them. And I think it's a very deliberate strategy to seed market share now, hope that the market ultimately corrects in terms of pricing. And I think once that point is ultimately reached, I think you'll start seeing them hopefully starting to come back into the market.
Is there any evidence that that is what's going to take place? Because there has been a lot of speculation that the CBA losing market share is going to be forced back into that mortgage war.
Yeah, there's a lot of pressure on the management teams every single month. The industry data comes out, and ultimately, everyone pays a lot of close attention to what's happening with relative market shares. They're still a very big player in the market. They've got circa 25% market share. And clearly, I guess, under those kind of pretenses, arguably they do have the most to lose. But you also saw CBA was one of the first banks to actually remove cashbacks in terms of their offering. So their price points are a little bit higher if you go and have a look at their rate card pricing, but I think to what we called out previously, I think it's a very deliberate strategy at this point in the cycle.
Which of the banks are being most aggressive in chasing home loans, and are they taking a hit on the cost of lending?
Yeah, so the margin debate's been around in this market for at least the last kind of 6 to 8 months. And certainly the pricing points potentially showing that some mortgages are being written at below cost of capital for the Australian banks. So I think one bank that's been relatively more aggressive in the market has been Macquarie. You've seen a noticeable increase in market share for Macquarie, particularly over the last 24 months. They've got roughly 5% market share now. And then some of the international banks, their pricing points themselves are actually quite low. We'd probably call out someone like an ING here as one of those examples.
How does this translate to the price of bank shares? Which banks are performing strongly on their price to earnings ratio?
Yeah, it's been a mixed bag during the course of the year, actually. I mean, the banks generally have been actually underperformers relative to the market. So we wrote a note called The Good, the Bad and the Ugly just ahead of results season coming up. And in that note, I think we called out that the bank's relative share price performance, they were down roughly about 2.6% relative to the market. That was down roughly about 20-30 basis points. Banks that have done better have been ANZ. They've got a more diversified business model if you had to have a look at them relative to the more domestically mortgage-focused banks here. So banks that have done poorer have been Westpac, the two regional banks, and then NAB. CBA has actually probably been middle of the pack in terms of relative performance.
You are forecasting that ANZ will deliver strong results next month. You are also singling out Macquarie's performance. You've touched on it a little. Can you give us a greater assessment of what Macquarie is doing at the moment?
So Macquarie, in terms of their domestic business, they've been growing quite strongly in terms of BFS. That's their business unit here, and that's really the mortgage strategy and story that we've spoken to. The other parts of their businesses are more focused and are more geared towards capital market activity. Overall levels of capital market activity have been actually quite weak, particularly in terms of primary markets. You haven't seen, as an example, a lot of things like IPOs. You haven't seen a lot of asset sales that they've been involved in. But the one part of their business that has been a very strong performer in the last 2 years has actually been their commodities-focused business. That now contributes, or as of their FY23 results, contributed roughly 60% to pre-tax earnings. And we think with reasonable degrees of volatility in commodity prices still, that division could be a strong performer in the second half of their financial year.
And so how strong are the headwinds for the domestic banking sector, given that we are in a per capita recession and the RBA's outlook is tending more hawkish? Are the banks looking now at worse than expected bad debts?
We would have thought that would have been the case probably at the beginning of the year. So I think the market was really relatively negative around what the asset quality cycle potentially could have been. I think people have actually pared back their expectations now. So credit loss ratios for the sector were probably north of 20 basis points. If you look at consensus forecasts and UBS forecasts, we're probably closer now to 17 to 19 basis points. So the expectation was rates had gone up very quickly, consumers are under a lot of duress. But I think the fact that you've seen relatively strong real wage growth increases actually come through, I think has helped to offset that. And corporates, for what it's worth, are actually, particularly large corporates, are in a relatively strong position with regards to levels of cash they're still holding.
John Story, thank you.
Thank you.